Welcome to the debate. Today, we're looking at a number that should frankly terrify anyone with a brokerage account. 95%. That's the failure rate for active traders. But if you peel back the layers of that statistic, you find something even more disturbing. We aren't just talking about people treating the market like a scratch-off ticket. We're talking about doctors, engineers, trial lawyers, CEOs. These are people who have spent their lives conquering complex challenges through sheer intellect. They come to the market, apply those same high-performance habits, and just get absolutely slaughtered.
It's the great graveyard of the intellectually arrogant, isn't it? The market is pretty much the only workplace on earth where you can do everything right. You study the charts, you read the reports, follow the news, and you can still lose your shirt. But the question isn't just that they fail. We need to answer why. Why does high intelligence so often seem to correlate with poor trading performance?
And that right there is the central tension we're debating. Is the solution found in better analysis of the market? In, predicting the future with sharper tools? Or is it found in a radical reanalysis of the human mind? I'm going to argue that the holy grail of trading is entirely internal. It's about closing what the source calls the psychological gap. The market is neutral. Success comes exclusively from mastering mental analysis and neutralizing fear.
Okay, and I have to push back on that immediately. I respect the psychological component. I do. But I argue you cannot mindset your way to a profit in a vacuum. You can be the most Zen monk in the world, sitting in total tranquility, but if you buy at the top of a downtrend, you are going to lose money. So for me, the key is the external framework. You need a defined edge, specifically technical analysis, that organizes all that collective irrationality into probabilities. My argument is that you can't have psychological stability without a mathematical structure. Think of it like a casino's business model.
The casino model is a perfect image for this, and we'll get there. But we have to start with the environment itself. Why do the doctors and lawyers fail? My position is that the market is, it's a boundaryless environment. In our normal lives, society provides structure. If you're a surgeon, you have a strict protocol: scrub in, incision here, clamp there. The environment gives you the rules.
Structure provides safety. It gives you a feedback loop that says good job or bad job.
Exactly. But in the market, there is zero structure. You have total, absolute freedom. You decide when to start, when to stop, how much to risk, when to walk away. The market will never, ever tell you that's enough, you've lost too much today. It will happily let you liquidate your entire 401k in an afternoon without even blinking. And this freedom is just psychologically overwhelming for people who are used to rules.
Which is precisely why I argue that the freedom is a trap.
It's a catastrophe. It's a catastrophe for the unprepared mind. Because the market doesn't provide the discipline, you have to provide it. And this is where the smart people fail. They try to impose order on the market through analysis, thinking if they just understand it enough, they can control it. But my core thesis is this: the market is neutral. It simply generates up and down ticks. It's just data. It doesn't know you exist. So the pain a trader feels, the fear, the anger, that sense of betrayal, it's all self-generated. It comes from what our source material calls the association mechanism.
Okay, you're using that term association mechanism, but let's not leave it as a buzzword. What's actually happening in the brain there?
It's the mechanism by which our brain links sensory input to memory. It's an energy efficiency tool, really. If you touch a hot stove, your brain instantly links stove with pain. You don't have to think about it next time. The problem is we project that onto the market. If you buy a stock and it drops, your brain links trading with pain. So the next time you sit down to trade, you aren't looking at a neutral screen. You are looking at a source of threat. You're projecting your own past trauma onto a neutral screen. So doing more market analysis to make sure you don't lose is actually a trap. It's the black hole of analysis.
I understand the mechanism, and I don't deny that these trauma loops exist. But I believe you are dangerously underestimating the necessity of the tool itself. You say more analysis is a trap, but I would argue that no analysis is suicide. If you enter the market without a framework, you're just liquidity for the professionals. My position relies on what I'd call a probabilistic structure. Let's go back to that casino analogy in the text. A casino does not win because the floor manager has a carefree state of mind.
No, they win because the odds are rigged in their favor.
They win because they have a statistical edge. That is the definition of an edge. A higher probability of one thing happening over another. The casino knows that over, say, 10,000 hands of blackjack, the math dictates they will capture roughly 4.5% of the turnover. They don't know if they will win this hand. In fact, they might lose 10 hands in a row. They don't care. They care about the aggregate. Individual traders fail because they think they're the player trying to win a jackpot. They need to become the casino.
But that is a massive leap to ask of a human being. We aren't algorithms. We have rent to pay.
You become the casino by using technical analysis. While any individual trader is irrational, their collective behavior forms patterns that repeat with statistical reliability. That's what a chart is. It's a map of human psychology in motion. So, my core thesis is that you cannot have the psychological detachment you're asking for without a concrete system to rely on. The trader's edge, that technical criteria, provides the rigidity and rules that allows for the psychological flexibility you want. You need a structure to trust before you can trust yourself.
I understand the logic, I do, but it falls apart when you look at the reality of human biology. Let's dig into why traders can't follow that structure even when they have one. A trader can have a perfect system, a perfect edge, and still just freeze when it's time to push the button. This brings us to the boy and the dog illustration from the text, which is a perfect proxy for how this irrational behavior is born.
It's a classic psychological model, sure, but lay out the mechanics for us.
Okay, so imagine a young boy. He interacts with a dog for the very first time. He's curious, he reaches out, and the dog bites him. It's a traumatic event. The boy's in physical pain, and he's terrified. In that moment, his mind creates a permanent association. Dogs equal pain.
A survival instinct. The brain is doing its job.
Right. But now, fast forward 10 years. The boy walks past a different dog. This dog is friendly, it's wagging its tail, wanting to play. The environment is objectively offering an opportunity for love and play. The market of the dog is signaling buy. But what does the boy perceive?
He perceives a threat. He crosses the street.
It goes deeper than just the decision. And this is the crucial part. His association mechanism physically blocks him from seeing the wagging tail. The fear causes what's called perceptual blindness. He literally sees a monster. He picks up on a growl that isn't even there and ignores the tail that is. Now apply this to trading. A trader buys a stock and it crashes. They get bitten. They lose money they couldn't afford to lose. So the next time the market sets up in a perfect, high-probability pattern, your technical edge, the trader doesn't see an opportunity.
They see the teeth.
Is blinded by past pain. You can show that boy a chart proving 99% of dogs are friendly, but if his adrenaline is spiking, he isn't reading the chart, he's running.
I agree that the mechanism exists, but I think you're drawing the wrong conclusion from the story. You're focusing on the individual's internal pathology. I'm focusing on the collective outcome. We don't need to psychoanalyze the boy to trade the dog market, so to speak. We just need to know the probabilities. If we look at the market, we know that it's composed of millions of irrational participants, people acting out of fear, greed, or that very same boy and the dog trauma.
But if the trader is one of those irrational participants, they lose. You can't profit from a market you're too scared to even enter.
Unless they rely on the pattern created by the others. Technical analysis is the tool that accounts for this collective irrationality. We don't need to know why the market is selling off. We just need to identify the pattern that indicates most participants are selling. The edge is simply a higher probability of one outcome over another based on this collective behavior. If the boy had a statistical chart showing that 95% of tail-wagging dogs are safe, and he trained himself to follow that chart mechanically rather than his feelings, he could overcome the fear. The structure overrides the trauma.
That is a very big if. You're asking a human being to override their core survival instinct with a chart. The source material explicitly states that fear causes us to distort data. If you are afraid, you will subconsciously look for indicators that support your fear and ignore the ones that support the trade. You will rationalize, oh, the RSI is too high, or, well, the news looks bad. You will find a reason to disobey the system because your brain is screaming, don't get bitten.
Which is why the discipline must be mechanical, not intellectual. But this fear we're talking about, it usually stems from a misunderstanding of what the market is even doing. And this touches on the concept of prediction. This is where the industry really lies to people, and it's where the smart people get into the most trouble.
Oh, it's the biggest lie in finance. Where is the S&P 500 going next? What's your price target?
The entire media apparatus is built on it. They sell certainty.
And that is the trap. My position is that you must relinquish the need to be right. The source material cites the uncertainty principle. Even if your technical pattern looks perfect, that edge you love so much, it only takes one trader somewhere in the world to negate your trade. Just one.
That's undeniably true. A whale enters the room, or a central bank makes a surprise announcement. The pattern collapses.
Right. So if one variable can change the outcome, then the outcome is uncertain. Always. There is no such thing as a guaranteed trade. Therefore, discipline isn't about perfectly predicting the market. It's about fully accepting that anything can happen. Discipline is the act of giving up the illusion of control. You don't need to know what happens next to make money. The doctor fails because he thinks he needs to know the outcome to operate. The trader must operate without knowing the outcome.
I agree on the uncertainty, but I just don't buy the discipline is purely about acceptance. That feels too passive. It sounds like you're telling traders to just float downstream and hope for the best. I would reframe discipline as the mechanical stage of execution. The source material says we must be rigid in our rules to be flexible in our expectations. That right there, that's the synthesis we need.
Expand on that. How can you be rigid and flexible at the same time?
You can't have mental discipline in a vacuum. You need a system to be disciplined about. The paradox is that we must trust the pattern, the edge, while simultaneously knowing the specific outcome of this trade is random. It's back to the casino manager. He is rigid about the rules. Dealer hits on 16, stands on 17. He never deviates. He is rigid, but he is flexible in his expectation of the outcome of any specific hand. He knows he might lose this hand. He accepts that randomness, but he trusts the math over the long haul. The discipline is in executing the system flawlessly, not just in accepting whatever the market does.
But here's the friction point. That casino manager isn't risking his own rent money. He isn't risking his ego. Individual traders are, and because they are risking their own sense of self-worth, they fall victim to the 4 primary fears mentioned in the text. Mark Douglas argues that 95% of trading errors, hesitating, jumping the gun, moving stops, taking profits too early, they all stem from 4 specific fears.
Let's list them so the listeners can identify their own ghosts.
Fear of being wrong, fear of losing money, fear of missing out, and fear of leaving money on the table.
The 4 horsemen of the account apocalypse.
Not solved by chart patterns. A chart pattern tells you when to enter, but it doesn't stop you from fearing being wrong. In fact, if you rely on the chart to predict the future and you are wrong, the pain is even worse. You feel betrayed by the chart. To solve these fears, a trader has to redefine their relationship to risk. They must take total responsibility. If you feel angry that the market took your money, you're blaming the market. You're expecting the market to make you happy. You have to realize the market owes you nothing.
That is a crucial point. The market owes you nothing. But I'd argue those fears persist precisely because traders treat trading as individual events rather than a numbers game. If a trader truly viewed their trading like a casino views a slot machine, as just a random distribution of wins and losses, the fear would vanish.
But how do you make that shift? It's one thing to say it, another to feel it when your P&L is flashing red.
You have to understand the difference between micro and macro. If I flip a coin and I bet on heads and it comes up tails, I don't feel betrayed. I don't feel I was wrong in a moral or intellectual sense. I just experienced a random variable. The solution to the 4 fears is adopting the probabilistic mindset. You have to genuinely believe in the law of large numbers. If I take this trade 20 times, I know I'll win 12 times. Therefore, this loss doesn't matter. It is just a cost of doing business, like a restaurant buying ingredients. You don't cry when you buy tomatoes for the restaurant, it's an expense. A losing trade is just an expense.
But that structural understanding you speak of, it has to be believed at a core level. The source material talks about our mental software. You can know the math intellectually. You can be a professor of statistics, but if your core belief is, I must not lose money, or I must be right to be worthy, the math won't save you. You will still hesitate. Which brings us back to the most fascinating part of this whole debate, the paradox of analysis. Why do the smart people fail?
The doctors and the engineers, the people who are used to winning.
Right. Think about how a surgeon is trained. If they are operating, they must analyze every variable. They check the vitals, the blood type, the history. If they analyze enough, they can control the outcome. They can save the patient. An engineer calculates the load to ensure the bridge doesn't collapse. In the real world, analysis equals control. Analysis equals safety.
And they bring that same equation to the market. They think if they just read one more Federal Reserve report, they can predict the bottom.
And the market destroys them for it, because they're trying to eliminate the unknown. They fall into that black hole of analysis. They think, if I just add one more indicator, if I just read one more economic report, I can guarantee this trade will work. But the more they analyze to avoid risk, the less they are actually accepting risk. They build this wall of data to hide behind. My position is, you have to stop trying to figure it all out. You have to enter the carefree state of mind.
I accept that analysis paralysis is real. I've seen traders with 6 monitors and 40 indicators who can't make a dime. However, I have to counter that the failure isn't the analysis itself, but the application of it. You don't analyze to predict the future, you analyze to identify the opportunity flow. The source material talks about the zone being a synchronization of the trader's mind with the market's collective mind.
Yes, being in the flow, like a surfer in a wave.
You can't surf if you don't know what a wave looks like. You need the technical skills to recognize the language the market is speaking. If you don't know what a support level is or a reversal pattern, you aren't in the flow. You're just drifting in the ocean. The smart people fail not because they analyze, but because they analyze for the wrong reason. They analyze to be right. They should be analyzing to define their risk and reward. The analysis frames the bet. It doesn't guarantee the outcome.
That is a critical distinction. Analyzing to be right versus analyzing to define the bet. But I still contend that the ability to accept that the bet might lose is a psychological skill, not an analytical one. The source material mentions that the best traders, the ones in the top 5%, can put on a trade without the slightest bit of hesitation, and if it goes wrong, they exit without the slightest bit of emotional discomfort. That's not math. That is emotional regulation. That is attitude.
It is attitude, but, and I'll sound like a broken record here, it's an attitude forged in the fire of probability. You cannot be emotionless about losing money unless you are absolutely convinced that the loss is temporary and the gain is inevitable over time. And the only way to believe that is to have a proven edge. You cannot have faith without evidence. The edge provides the evidence.
Let's look at that opportunity flow you mentioned. I believe that when you are in the zone, you aren't thinking about the money. You aren't thinking about the rent. You are simply available to what the market offers. If the market offers a buy, you buy. If it changes, you sell. There is no internal struggle. It's effortless.
Agreed. And that lack of struggle comes from having no expectations.
Exactly. Neutral expectations. You aren't imposing your will on the market. You're just listening to it.
But, and here is my final push on this, you need to expect something to trigger your action. You need a signal. The signal is the external trigger. The neutrality is the internal state. You need both. If you have neutrality but no signal, you never trade. If you have a signal but no neutrality, you trade with fear.
I think we're circling the synthesis here. It seems we're arguing two sides of the same coin, but for the listener who's stuck in that 95% failure rate, they need a practical way out. How do we summarize the path?
I'll start. I believe the source material makes it clear. A winning mindset is really a probabilistic mindset. You can't just wish your way to success. You have to treat trading like a business, specifically a casino.
You need an edge, which is your technical analysis, to give you a statistical advantage. And then you must surrender to the law of large numbers. You have to accept that individual outcomes are random, but your cumulative results are consistent. You build the framework, you follow the rules, and the psychology follows the structure. Fake the discipline until the math proves itself to you.
And I'll maintain that the structure is useless if the foundation is cracked. The ultimate shift is internal. You have to move from expecting the market to make you happy to making yourself available to what the market offers. You must stop trying to be right and start trying to be free. The goal is that carefree state of mind where you accept risk completely. If you are afraid, you are blind. And if you are blind, your charts are worthless. You have to fix the perceiver before you can fix the perception.
So is it the chicken or the egg, the mindset or the edge?
I think the source material guides us to the answer. It's the holy grail of integration. The novice trader must stop trying to predict the future. That is the black hole.
And start executing a system with the detachment of a casino owner.
You need the 5 fundamental truths embedded in your mind. Anything can happen. You don't need to know what happens next, and every moment is unique. Precisely. You need the rigidity of the rules to protect you from the boundlessness of the market, but you need the flexibility of attitude to see the market clearly.
A rigid system for a flexible mind.
That is a strong place to leave it. We want to thank you for joining us on The Debate. We encourage you to look at your last trading error. Don't just look at the chart, look in the mirror.
Ask yourself, was it the market that beat you? Or was it your refusal to accept uncertainty?
Until next time.